Yeah. Hey, Tay Vibes. Andrea, how you doing? Coco Berry, how are you? Tanisha, how you doing? Hey, on Vonnie. God's lady, how are you? Turn on for what? How are you doing? Tori, how you doing? Good for you. It's nice here, Tori. It's not burning up. It's nice. It's nice enough to be outside in a t-shirt, but it's not my kind of weather, which is 82 and up. Hey, Dr. Brown, Exo Family Health. Everybody, pay attention to that. She's going to be on CNN tomorrow morning at 7 a.m. Eastern. So take a look. Same lady that's been on here, giving you free knowledge is now being asked to come on CNN and give an update and her thoughts on what's going on in the country and the world. So, you know what? It don't matter where she goes from here. I had her first. So, okay, I'll start talking now. You guys are in for a treat today. You're gonna get free information from a top wealth advisor in the country. He's an expert in his field, and he, I was reluctant to ask him, because everybody's time is valuable, but money people are still working. Like my son, he's working harder than he ever has because people that have money are trying to protect it. So I was reluctant to even ask him. Ow, got a zit on my shoulder. I was reluctant to even ask him to come on, but I asked him. And I got a text back from him so quickly. I'm like, damn. He's like, absolutely. But you know what? He has a heart for helping people too. So, and it's funny because I only gravitate toward people that feel that way, and haven't known him that long. If you don't know who David Adefeso is, I guess I would say, well, you should know because you know how to read. So, but he's my sister-in-law's boyfriend, Tamar's boyfriend. So she's the youngest, if you didn't know. So I realize there are some people who didn't know who they are, don't know who they are. And I didn't always. I guess I knew the name. I knew the name Tony, but I didn't know. Before I met Trina, I didn't know she had sisters or anything like that. I didn't. So I won't take it for granted that everybody is. But he's going to come on and give us. Well, it's going to be a ton of information. I asked him to come on a little bit later because I like to give people, what's up, Bass? Because I like to give people a chance to come on, and a lot of times I'll double back, but you'll notice if it's somebody that wanted to come live, or if you're asking me, I'll double back, but I'm not asking doctors and nurses to double back and say shit. You just have to You just have to watch it again. And I'm not going to ask him to double back. So when we get started, we get started. And if somebody comes on and says, "What's this topic? What are we talking about today?" Well, I suggest they read, or I suggest that the rest of you set that person straight. Just keep them. You can hear her. Yeah, that's her. Yeah, that's her. She's doing something for Sister Circle right now. I guess they're saying goodbye. What's up, Jin Jin? Um, yeah, but they're doing some live thing right now. But yeah, that's her. She's in the kitchen. So that's where she does all her stuff from. And I like to be outside. And if I'm still doing this in the fall, then I'll have on a sweatshirt. And then, if it goes in the winter, then I'll have on 2 sweatshirts. But I'll do everything I can to sit outside, unless it's just, you know, ridiculous. And David just joined, and he's going to ask me to go live, which he did. So, without further ado. What's up, bro?
Hey, how you doing, Vaughn?
I'm good, man. How you doing?
I'm doing well. It looks like, hold on, let me adjust a few things over here. A few light-related things over here.
What, for me or for you?
No, for me.
Okay. Yeah, you are very bright.
Yes, maybe a little bit too bright. Turn a few things down here.
Take your time. So again, everyone else, I will, if somebody jumps on and says, "What's the topic?" and they didn't read my page or his, somebody please correct them, because I'm going to try not to yell at anybody.
Okay, that's better.
Yeah, that's what. Yeah. You're about glowing dark. So everybody.
One more thing.
Okay. That's right. Take your time, because what he's about to say is going to be well worth it. So, I mean, this is information you have to pay for. So, be patient and accept the information as it's given. You ready, bro?
Yes.
Okay. Everyone, welcome, David Adefeso. He's somebody that I met just a short time ago, a little under 2 years, I guess. But he's someone I consider a friend, and he's someone I recognize as an expert in his field. So for those who don't know, David, tell us a little bit about yourself, please.
Of course. Can you hear me? Okay. All right. Well, I have a very interesting story, I think, Vaughn. Thank you. It's a pleasure to be here. It's our first live together, and I'm looking forward to having fun. I have an interesting story. I'm Nigerian. I'm from Lagos. I came here. I was 21 years old, my 21st birthday. I hopped on a plane by myself. I had $250, and I landed at JFK. And I had to get from JFK to LAX, where I knew one cousin and her daughter. It took me 5 hours. I got an airline called Braniff. They're out of business now. They took me for $198. No reason, no surprise why they're out of business. And they took me to LA. And I landed LA. I had $58, and I had to figure things out. 4 years later, I was at Harvard Business School, I went to Wall Street after that. Before that, I became, passed my CPA exams, became an accountant, and went to Wall Street, worked as a Wall Street investment banker, did a lot of M&A deals, about $100 billion in deals. And I left. I didn't like the Wall Street lifestyle. I'm more about helping people than Wall Street is more about making money. And set up a financial services firm. And 18 years later, we've grown multiple offices around the country. Done very well, thank God. And now I want to give back. And a big part of why I'm doing what I do now is to help our people, and give back what I've been given over the last 30 years in America.
Amen. Good. So, what made you choose how did you get started? Okay, so you want to give back. Great.
Yes.
What was the thought process behind and how did you get started doing so?
Well,
What did you, how about this?
this
What
I'm
was the opportunity that you saw that was being missed by so many? How about that?
absolutely Vaughn. There's a disparity of wealth in America. Uh,
Amen.
is getting worse and worse.
Yes,
Okay,
sir.
so between the 1950s and 1980, you could, go to college. Average American could buy a car, you get a good job, work there till they retire, get a pension plan called a real pension plan, retire at age 62 or age 65, and get a retirement benefit, live for the rest of their lives happy. And at the same time, they could raise their kids. They could send their kids to college, with no student loans. The kids went on to get good jobs, even better jobs, and make more money than dad, and be millionaires, and so on and so forth. So you had the opportunity to basically do better for yourself and your children. Since 1980, that has changed. And pretty much what has happened is the disparity of wealth has become so concentrated in one group of people. The Brookings Institute, a very renowned institution, wrote a paper in 2013, and by the way, it's gotten worse since then. And the paper talked about how the wealth disparity, the 1%, you've heard the 99%, the wealth disparity has is what stops what you call social migration. Social migration, which you might be, you know what that is. It's your opportunity to move up in life. To get a better job, you have to move up to social strata. To get a, buy a different car, to marry a, a beautiful, a nice girl, who a nice man, and to, buy a better house. Most of us want to do better. We want to make more money. That's called social migration. Wealth disparity is causing a reduction in social migration. It's keeping people here from rising. And the major cause of that wealth disparity is income inequality. Let's talk about income inequality.
Yes.
The 1%, now you hear about, the median income in America is $63,000, and that's median. That's when you take everyone. When you take the 1%, the average income is about $421,000. The remaining 99% make about $50,000. Now, I know where you live. It's not cheap, but where I live is even less cheap.
Yes, sir.
And what does $50,000 do for you? You got to pay your rent. You got to, 2 kids. Average American has 2 kids. You got to feed them. You got to send them to college. You got to, maybe, hopefully buy, a house one day. You got to, go to a restaurant, a couple times a week. You get nice food. Before you know it, your income is gone. There's nothing to save. And that lack of income for that 99%, the ability to take a little bit of their savings and invest it in a way, is what is causing this lack of social migration. And it's getting worse and worse. And what the Brookings Institute wrote and said was that problem is becoming permanent.
Wow.
What that means is for many of the people, look, let's say there's 100 people watching, right? It's more than that, but let's say there's 100 watching. By default, 1% of those people is part of the 99%, makes about 420. The remaining 1%, one of those people is part of the 1%. The other 99 are part of the 99%. So for most of the people watching, unfortunately, your children may never be as good off, as well off, or as rich as Donald Trump's children. Your children may never have the opportunities that Jeff Bezos' children. Jeff Bezos owns Amazon as his children. Your children may never be as wealthy as George Bush's children, because they're part of the 1%. So what I am doing now, what I plan to do, is to change the rules of the game. Get you to the point where you become one of the 1%. You can help make more money. You can help reduce your taxes. You can help raise yourself from wherever you are and you can make your money work for you instead of you slaving and working every day, going to work, and you work till you're 65 years old. Sometimes I went to Walmart the other day in Texas, and I saw some ladies. They must have been 90 years old, opening doors. They called greeters. I mean, how does that happen in America? So that American dream that we were told as kids, and we told our children, for a lot of people is non-existent. I'm going to give you the opportunity. I'm going to give you the tools to get back to that, to become one of those 1%, if you choose.
There you go.
That's why I do what I do.
Awesome. And I hope that people are paying attention. He gave us a ton of information, and it's a lot of it. The understanding of what he's saying is very intuitive, because most people readily accept that they won't be part of the 1%. That some people start off, with a silver spoon. I always say that. Yeah, I went to high school with a bunch of rich white kids. And I heard a guy say this when I was a sophomore, that he was born on third and he thought he hit a triple. He thought he did something by being born into the right family. So he woke up on third base because his dad did what he was supposed to do. But the kid thinks he hit a triple. For the rest of us, we knew that hard work and determination, some ingenuity, is what was going to get us to the next level. Now, understand those things, but you have to break coding on what exactly that means. And for everybody who's paying attention, that's what David is talking about.
Yes. I'll give you an example. There's some now, whether you're white or you're green or you're blue or you're Asian, I can't blame you for being born into a certain status quo. I can't blame royalty for being born. The guys in Britain, they're born into Prince Harry. I can't blame him for being born special.
Right.
It's his. He got it. Some of us have to, slave to get, even close to that point. And so the ones of us who have to do that, I'll give you an example of how it works, right? Imagine that disparity of wealth, and imagine a guy who's part of the 1%, right? Here's how it works. So he has a 401k. He has, he has a nice house, and he has money in the bank, and his kids or her kids are around the kitchen table. And, when he dies, he has a nice life insurance policy. He has the house he gives to his child. He has a good education he can afford without student loans. He has, a few $100,000 or a couple $1 million that your kid inherits. And he has, more importantly, the kids are listening around the kitchen table to mom and dad talking about how to build and how to maintain wealth. And that guy comes to people like me. He has smart, CPAs and accountants and investment advisors who help him reduce his taxes. And by the way, we're going to talk about reducing taxes today. And that's the first point. I'm going to give you concrete steps, ways to reduce your taxes. And so that family and those children who are soaking up that wealth of knowledge and who are inheriting, a good education, and who are inheriting a lump sum of money and a nice house, from daddy, that's one category.
That's
then
right.
there's the rest of us.
The rest of us.
Those folks who your parents didn't know have that financial education to teach you. They didn't teach you about taxes and intergenerational wealth planning. They didn't teach you about investments and stocks and bonds. They didn't teach you about, the best use of your time and, how to go to college and be an engineer or a lawyer or a doctor or an accountant. The best you learn how to do is, whatever it is you're doing. And so those are our people. Whether, they're black or white or green, those are my people, right? They're still there. They're one of the 99%. And those are the people who I want to level the playing field. So the truth is, many people are not lazy. I was talking to a good friend of mine who, his wife is, renowned, TV personality. And we had, she and he worked together. He manages her affairs. And we had a conversation. He said, you know what, Dave? And he's black. He's a black guy. He said, you know what, Dave, growing up in Brooklyn, I got lucky, because, I met, he had a role model. Many people just don't know. They don't know what to do. They don't know you should go to college if you can, get a good degree. They don't know you should, invest. They consume. They don't know those Gucci, $3,000 Gucci shoes may not be the best investment because they go down in value. Instead of that, buy a stock that goes up in value. They don't know. And so it's incumbent on people like us to teach them. They don't know about health. They don't know about wealth. They don't know about wellness. It's incumbent on people like us to teach them. In our community, I mean, what you're doing is, Vaughn, I got to tell you, is, I see a lot of your posts. I follow your page religiously.
Yes,
and I also, I admire a lot of what you're doing. With your, and I tell you this not because you're my brother-in-law, future brother-in-law, however that works, but I tell you this because I really appreciate it for me and for people around me, because there are a lot of people in our community who don't know. We don't know not to, put the salt down. There's a history of obesity in the African American community. Put the fat and oil my mom used to cook with. It took me a while to learn that. Look, I have a history in my genetics. That maybe those bad habits aren't a good thing for me. And so what you're teaching people, wellness, health, how to stay safe, how to be better, how to take care of your body. And when you take care of your body, your mind and your body are connected. Your mind you get more mental clarity. And part of that is taking care of your finances. So health, wellness, and your finances. I'm here to talk about the finance part.
It's all tied together, because here's the real answer to it. And I'll break it down into very simple terms. The more money you have, the better you tend to take care of yourself. The more money you have, the more you take care of the foods that you put into your body. The food take time, the meal prep and all of this. I try to do, wellness for dummies, for people that don't have a lot of money, don't have a lot of time. But the thing is that if you can learn how to gain more wealth, how to better manage whatever amount of money you have by listening to this dude, it opens you up and allows you to afford you all the other things they bring about. That's why, it's funny, because the people that watch me regularly, there aren't a lot of you, but the ones that do, it doesn't matter who comes on with me, it always ties into something else that somebody said, and this is no different. But the difference is that by doing this, you can change the trajectory of your family by changing not just the amount of money you make, because it's not about how much money you make, it's about how much money you keep. So it's not just making money, but the things that he said, I hope you guys were listening when he said these children of these wealthy people were sitting around the kitchen table, and their dad was talking on the phone to his friends, to his wife about the day, and they're just absorbing by osmosis all of this stuff. So everything that they're talking about is okay. Thanks. Tamar just said my camera, but thanks, Tamar. And it might be me. Your sister is on a live in there. She's sucking up all the bandwidth. But anyway, they're getting it, and I learned that because I went to an all boys high school, was predominantly white. Only 8 of us in the school, and just some of the conversations that I was privy to at lunchtime and after school, and riding on the bus to football and basketball games, or going to a friend's house and just hearing their parents talk. Like, I was hearing a little bit because my mom was an office manager at New York Life Insurance Company, but it was like I was hearing tidbits from my mom, but then the story started to fill in as I spent time with other people. So instead of you having to do all that, I brought an expert to you. So go ahead and just talk, whatever you want to talk about.
I want to talk today about something you said, Vaughn. You said it's not how much you make, it's how much you keep. And that is the first rule. That's where you really start, right? You said it right. Look, those who have money, right? Many of us want to work harder. We want to, get a second job. I remember growing up, I had 3 jobs. I came to the U.S., I had 3 jobs. I worked as an accountant during the day. I did tutoring in the afternoon, and I worked as a waiter at a place called Tony Roma's. Hey, I think it's out of business now in Carson, the Carson Mall. I had 3 jobs. And so then I didn't know. I mean, I was working harder. Unfortunately, later on I learned it's not how much you make that matters. It's how much of what you make that you keep. So today, I'm going to give the viewers some concrete steps, things that if you're listening now, some of those things I'm going to give you will save you $1,000. Some will save you $2,000. Some will save you $5,000. Some will save you $10,000 or $20,000. and I'm going to give them to you now.
Awesome.
And hopefully you can use them. But I'll tell you one thing.
Take note.
I've always thought that knowledge is power.
Yes, sir.
I was partly right. Knowledge plus action equals power.
There you go.
So I can give you all the knowledge you want. Vaughn, you can talk about, health and wellness and, what to put in your body and what not to put in your body, those nice pictures of the fruit and not to the fat. If you don't take action and you get to the grocery store, if what you're doing is buying saturated fat and processed, foods instead of fresh fruits,
right,
then you don't have any power. You have the knowledge, but you don't have the power. Same thing. I'm going to give you all these great things you can do. If you don't take action, if you don't get up, put your clothes on, go walk out the door and go take action, pick up the phone, take action, then you don't have any power.
That's
so
right.
I'm going to step back and taxes, are what I call the silent killer. And, it's interesting because when I was at Harvard Business School in the mid-90s, I was 94 to 96,
okay.
I heard, we had all these speakers. There was Andy Grove at Intel, Bill Gates at Microsoft, and this guy called Warren Buffett. It's this little, he's worth $80-90 billion now.
Right.
He owns a company called Berkshire Hathaway. Warren Buffett. It's called the Oracle of Omaha. And, we admire him very much because in our industry, he revolutionized investing. And he said something which was very important. He did a survey of his staff, and he makes billions a year. He's what, 80-90 billion. He makes billions. $2-3 billion is what he makes per year. It's like, okay. And he did a survey of his office to see what tax rate they paid. He paid about 17.4% in taxes, less than any of the people he worked with. A guy that wealthy was paying so little, and the people who were making $50, $80, $100, $120,000 were paying more. How does that happen? Talk about disparity of wealth. Talk about the reduction of more social migration. Talk about income disparity. So now I'm going to try to level the playing field starting today. And by the way, for your viewers who are interested, I just started last week. It was a little stilted. I just started a YouTube channel. Again, it's to give back, to educate people. Just type in my name, David Adefeso. It's called, we don't have a name yet, but it's David Adefeso's channel. It's on YouTube. It's every Mondays. And I'm going to be teaching people these things. The first thing that you should, so we'll talk about taxes and how to minimize your taxes. One more thing before I jump into specifics, right? As an investment advisor, right? I invest money. I invest for millionaires. I invest for billionaires. I work with some of the largest companies in America, and people come to me, and I see a lot of people who tell me, David, and I ask them, how much are you interested in making, so I get an idea of the risk they're willing to take. And some people tell me, I want to make 10% rate of return. I want to make 12% rate of return. I want to make, they focused on rate of return. And then I ask them, well, you want to make 10, you make 12, you want 15% rate of return. Have you thought about the 40% you're paying in taxes? And many of them look at me and they're like, what do you mean? And then I tell them, well, guess what? You actually pay more than 40%. And then they're stunned. Because most people think of taxes like income taxes. Well, income taxes are only half of what you pay.
Part of it.
Let me give you an example. They're only half. Let me give you an example for the average person. Let me give you an example. So you make money, you make 50, 80, 100,000, whatever it is, you pay 25, 30% in taxes, right? That's federal taxes. If you're in a state like California, we pay 10 to 13%, 9 to 13% in taxes. Add that to your 25, 30%, we're talking close to 40%.
That's right.
And a little sidebar, I've heard a lot of discussion about, lower tax states like Texas, like Florida, look, states are going to make money somehow. Some states like Texas that have, and I have an office in Texas and in Fort Worth, in the Fort Worth, downtown Fort Worth. And in Texas, you don't pay any income taxes, but guess what? Your property taxes are almost double those in California.
Right.
So they got to get their money somehow. Delaware, there's no low corporate taxes, but guess what? You pay taxes on the corporate on the stock. The amount of stock is the only state that I know that does that, and the amount of stock that you own. So states are going to have to make money somehow. So when you add your federal taxes 25, 30% to your state taxes, That's about 30 to 40%. Well, how about payroll taxes? Payroll taxes are 6.2% Medicare, 1.45 Social Security. It's about 7.65%. If you're self-employed, double it. You're paying 15.3%. So it's capped in some ways. You know, the one portion of it is capped, but you're still paying 7.65. Add that to your 40%. We're talking almost 50%. How about property taxes? You got to have a nice home, right? Or you got to pay anywhere between 1 and 2%, depending on what state you live. How about sales taxes? Yeah, see that nice chair you have behind you sitting on? You have to pay sales taxes. In our part of town, it's over 9%. And how about airport taxes? You ever look at your ticket prices, your airline ticket, the taxes on there? It's chock full of taxes. How about gasoline taxes? You go by, it's almost 50%. How about estate taxes? The government taxes you while you're alive, and they tax you when you die.
Hold on, and listen, this is, and I want to drill this in. Estate tax are tantamount to the devil to me, because a person makes money. Let's say they made $5 million that they're going to leave for their family. To put $5 million away, he already had to pay taxes on it. Okay, he already had to pay taxes on it. Now he dies and wants to give it to you, and the government wants yet another piece. And no further transactions have happened. He made it, paid his taxes on it, put it in the bank. Now he's going to transfer the wealth to his family, and now the government gets yet another chunk. Go ahead.
The rules have changed a little bit with that. You know, now it's up to 11 million. You know, there's a couple they exclude up to 11 point something million. But still, you know, for those rich people, you know, they still get to pay estate taxes. You know, if you have over that limit, and so you're paying taxes upon taxes upon taxes, income, federal, state, estate. Before you know it, the average person pays somewhere around 59 to 72%. So you wake up on December 31st, you look at your bank account, you're thinking, well, I mean, I haven't spent that much. There's nothing in there. You're wondering, well, what happened? What happened? Taxes, my friend. So the first part of what rich people do is they minimize tax. I'm gonna give you a few things you can do. The first thing as an employee,
here we go.
Most people who are listening are probably employees. Most of you don't have jobs that you do. You don't run companies and all that. That's okay. You know, that's the majority of the workforce in America. Right. Most employees who have a W-2 income have something at work called a 401k. You get to put up to $19,500 into your 401k. Let me tell you what a 401k is. In 1973, the federal government decided Americans are very bad savers. And as a result, they're going to do something for us. They're going to give us what I call free money. You're going to make money, and they're going to give you the opportunity to take your own money from one hand, this bucket, and put it into this bucket and deduct it for tax purposes. Holy Creole. What? It's still yours. You just move it from here over here and you deduct it for tax purposes. It's a wonderful, wonderful thing. And to make it even better, it's tax deductible. And every time you make money, Albert Einstein called it the greatest gift on earth, the greatest power, or one of the greatest powers on earth is the power of compounding. So you invest that $10,000 and you make, say 10%, you make $1,000. Well, instead of paying taxes on the $1,000, you take the whole 11,000 and it grows again to 12 and 13 and then 15 without paying any tax. You only pay taxes when you take it out. So it has the ability to compound and become very, very big. But that's not all. 95% of American companies do what's called a match in a 401k plan.
That's right.
So in addition to tax deduction, tax deferral, it's protected from your creditors. Did I say that? You can't get sued for it. They can take your home in some states. They can take your bank account. They can't take your 401k. So
right.
In addition to the amazing benefits, you get a match. Your company gives you what I call free money. Some companies give you 3% match. They give you 6% of whatever of your pay. So if you make $50,000, you put in, say, I don't know, 10% of your pay if you're able to, right? Which you should try to. You do $5,000. Your company will give you $5,000 free money. Take it. Take the money. Even if you don't have more than that, do at least what the match is, right? Most companies don't do 10, but they do up to 3, some do 4, some 5, and 6. So the first thing you want to do to increase your wealth, to reduce your taxes, to grow your income, your what I call your sleep money income, money you're not working for, is to do your 401k. I'm gonna come back to that money you're not working for in a second, what I call sleep money. But the first thing you want to do is a 401k. Now, If your company doesn't have a 401k, I sympathize with you. Give me a call. We'll make sure they set up a 401k. But if your company doesn't have a 401k, you still get to do an IRA. With an IRA, you don't have a $19,500, but you still get to do up to $6,000. You still get to do something, $6,500 or something. It was $6,000 last year and $6,500 this year. You still get to do something that is tax deductible and that grows tax deferred. And even though you don't have a company match, it's still really good money that's growing for you. And so the first thing you want to do if you're an employee is you want to do a 401k. Well, but that's not all in terms of tax deduction. There's something in Money Magazine called the best kept secret for small businesses. Money Magazine, CNN Money Magazine, best kept secret for small business. You know what it was? It's called the Defined Benefit Cash Balance Plan. Google it. Defined Benefit Plan or Cash Balance Pension Plan. What it is like a 401k on steroids. It's for business owners. So you're making money. This is for people who are making money. You're making 200, you make 300, you make 400. So let's say you make $500,000 in your business, whatever it is you do as your revenue. You maybe have $100,000, maybe $200,000 in expenses. You have a profit that gets taxed. That $300,000 will get taxed. Sure. You can put all of that $300,000 or a portion of it, depending on your age, into a defined benefit pension plan or cash balance plan. Guess what? That $300,000, it's depending on your age, is tax deductible. You don't pay any taxes. So if you're paying $50,000, $80,000, $100,000, $120,000 in taxes, you live in California, you put $300,000 into a defined benefit plan, you just wiped out your taxes. Because your tax rate at that rate is somewhere close to 40 to close to 50%. You just wiped out your taxes. So now, if you're a business owner, we just wiped out your taxes. Was this broadcast worth it or what? But I'm not done. So that's the second thing. If you're a business owner, the first thing you want to do is if you're an employee, you want to do a W-2. You want to do a 401k. If you're a business owner, you want to do and you have cash flow and you have a profit, you want to do a defined benefit pension plan. But that's not all. Here's the third thing I'm going to teach you that rich people do. It's called real estate. Real estate, investment real estate, we're going to get to your own personal property in a second. Investment real estate is one of the best kept secrets for reducing your taxes. Why? There's something called depreciation. There's a magic called depreciation. It's magic, right? Here's what it is. So you buy a piece of property, right? You rent it out. You make $10,000 in income, in rent. You've got to spend money to paint the place. You got to pay property taxes. You got to pay your mortgage. So you pay $8,000 in expenses. You have $2,000 in profit, right? You're supposed to pay taxes on that. Let's just call it, I don't know, 40%. So you're supposed to pay $800. And now I'm using this number as a small number. You can multiply by whatever multiple you want, 100, 10 times, even depending on the size of the real estate. You don't actually pay taxes on that 2,000, right? Because you have this thing called depreciation that wipes it out. What's depreciation? It is a non-cash item. It doesn't involve any cash coming out of your pocket. So let me explain. Normally, to have a tax deduction, you have to spend money, right? You have to pay your employees, money going outside. You have to pay for rent, money leaving your bank account. You have to buy a desk, money going out. You have to buy a nice computer, it's money going out. Depreciation does not involve any money going out. Here's what the government is telling you. You bought that piece of property, right? It's a nice piece of property, right? That property price goes down. The property goes down in value every year. Are you serious? The property goes down in value every year. And so we're going to allow you to put a little bit of money aside every year. So in 25 or 30 years, you can buy a new one. You can replace it. It's called the replacement cost. Huh? Real estate go down? Nah, real estate goes up in general. Now, sometimes it goes down. 2008, it went down. In general, real estate goes up. So the government is giving you a tax deduction because they're assuming real estate goes down. But it doesn't. It usually goes up. Donald Trump. Look, we're not talking politics over here, right? But Donald Trump is a real estate guy. Many people talked about his taxes, release taxes, not release taxes. I don't know about that. I don't know about release taxes or not release taxes. But I'll tell you something. He's a real estate guy. And there's a very, very, very good chance that Donald Trump and other real estate investors that I work with some of these people, pay less in taxes than you do. Why? Because they got real estate. They got depreciation. And they get that if you're a real estate person, and I'm not going to go to detail about being a real estate professional, you not just get to write off all your losses from depreciation, because depreciation creates an amazing amount of losses. You can deduct those losses against your ordinary income. So if you have another job, or your wife has a job, and you're a real estate professional, you can entirely wipe out all your taxes by this wonderful thing called depreciation. So investment property is a wonderful tax deduction. But that's not all. How about you own property? You own a property. You go out, you buy a piece of property, and you take a mortgage. Because most people can afford to pay $200,000 or $250,000 or $1 million, depending on where you live, to buy a piece of property. So they borrow money. It's called the mortgage. Your government will give you a tax deduction on your mortgage. Hallelujah. Look, I got to buy a piece of property for me and my family, right? I go buy a piece of property. I take a mortgage, my mortgage. And I get a tax deduction for it, for buying a piece of property for my family. The real estate that you own, residential real estate, is an amazing tax deduction. Mm-hmm. In addition, it's limited, but you get to write off a little part of your property taxes. I think it's up to $10,000. It was reduced to $10,000 or something now. You still get to write off your property taxes. So that guy who's renting, he's paying money out of pocket. No tax deduction. He's renting property. Meanwhile, you're buying property. You pay property taxes, tax deduction. You buy, you take a mortgage, tax deduction. Residential real estate is one of the best things that you can do for yourself to reduce your taxes. Now that brings me to we talked about 401k. We talked about defined benefit pension plan for small businesses. We talked about investment real estate. Now we talked about residential real estate. What real estate, especially resident investment property, does to you is the fifth part of what I'm going to talk about: turning ordinary income into investment income. Why? The tax rate is about half. You could pay up to 30 or 40% on investment on the income you work for. You pay 15% or less on investment property, on investment income. So let me give you an example. You go to work every day. You work really hard. You get a paycheck. It's called a W-2, right? That paycheck, you see taxes taken out, federal taxes, FUTA taxes, state taxes. You're working for your money. It's called ordinary income. That's the worst type of tax because it's very high. That's what most people pay. If you take a little bit of that money and you invest it in a stock, or you invest it in real estate, or you invest in gold, or you invest in a bond, what you've just done is you turned your ordinary income into investment income. Now you sell that property. You get taxed at a rate that's about half of ordinary income. In addition, you have money working for you. You're not working for your own money. Right. You have money that's working for you. That's right. Number 5. So we've talked about 401k, we've talked about defined benefit pension plans, we've talked about investment in real estate, we've talked about residential real estate, we've talked about turning ordinary income into investment income. I'm going to tell you something now about another one that is interesting. I used to be an accountant before, and I always saw people come in and they get excited on tax time, during tax time. For me, an income earner, I don't want to pay taxes that much. I got to pay it. So, tax time comes, I file the last day. A lot of people would come in, they want to file the first day to get their W-2. Why? They're looking forward to their tax refund. A tax refund is the worst thing you can get. It's the worst thing you can get. Here's why. Here's what a tax refund is. So you go work every day, you work hard, you make $50,000. You get a tax refund of $3,000. That tax refund is a loan you've given to the IRS, and they give you no interest. They don't give you any interest.
It's free. That's right.
They give you your $3,000 back. You try to owe the IRS money and see what happens. They don't give you an interest-free loan. No. You got to pay interest. You got to pay penalties. And sometimes they come after you. They take you to jail sometimes if you don't pay their money. That's right. IRS doesn't give you an interest-free loan.
Keep your money and give it back. That's right.
So here's what you do. I'm going to do a little exercise now. You don't want to get a tax refund. Tax refunds are no good. You want to take that money, and while you're working every month, take it out and invest it. Make interest. make dividends, buy a stock, buy a piece of real estate, whatever it is. And when the end of, yes.
I'm sorry to cut you off, but people, now this is where, if you're an employee, especially, what you do is you change your withholdings so that you bring more home. So understand that's what he's saying. Go ahead, Dave.
And so, Vaughn, you're absolutely right. So what you do then is, it's a little exercise. So how much did you get last year? Let's say let's say you got, to make it easy, $1,200 as a tax refund. Go to your payroll provider, go to your HR, get it something called a W-4, and then you want to change your W-4 to increase your dependents. So if you have 2 dependents, increase it to 3. You may have to do a little bit of wiggling to make sure you take that $100 out and invest that in a stock or a bond, and you make interest. And you get to keep the interest, and you're paying your taxes. At the end of the day, December 31st comes, you're richer than you were before.
That's right.
Right.
And another
And
thing,
so,
and let me point out one other thing. He's talking about taxes. Let me put it in perspective for you. If you work for a company, it doesn't really matter because you pay taxes whether you work for a corporation or for yourself. But on average, not everyone, but on average, you're working 4.5, 5.5 months of every year for the government. Think about it. So if you look at January 1, you don't get to start counting any of your money that's being made for you until May 15th in a lot of cases. So that's just like a mortgage. You know, when you pay your mortgage is $2,000, and you look at principal and interest, and you're paying, if it's $2,000, you're paying $1,820 in interest, and then you're paying $180. You're going to your principal for a term. But it's the same way with taxes. You are going to pay 4.5 to 5.5 months of taxes before any of that money is actually yours. That's, when you look at it that way, it's much easier to understand how much you're paying in taxes every year. Sorry, Dave, go ahead.
absolutely. No, thank you. And I think, I've thrown out a lot, and Vaughn, that's exactly correct. That's a good way to think about it. You're working 4 or 5 months for the government. Look, taxes are a necessary evil. You look outside, we have good roads. We have security.
Yeah.
We have we have the borders. We have things that the government provides, and we are thankful for it. Yes, we're thankful for it. But look, I don't want to pay any more than I should. You should pay your share. I don't want to pay any more than I should. And so I've thrown out a lot, for people to digest. I think maybe we should pause. And do you think we should take some questions?
Yeah, we've had one that's sitting, and I had another one that scrolled by, but it went by so fast because people are just are making.
Okay, so I'm curious about what people, we've talked about a lot of things. What is it that of the 5 or 6 or 7 things, which one of those do you have a question or that concerns you? Or which of those, do you have any other things that are bothering you? We'll throw out the finance thing. Any questions on finance?
I have one question. Should I use equity to buy real estate? Now, I want to answer that first, because I was in real estate a long time, own a mortgage company for 7.5 years. And I got hit like everybody else did in 2008. But I used equity to buy investment properties. I did it all the time. Some people will advise you against that. I want to hear what David has to say, but I did it personally, and we're going to find out if it was a good or bad idea. Go ahead, Dave.
By taking equity, I want to make sure I understand what you're saying. So you have a house worth, say, $500,000, and you have a mortgage worth $300,000. You pull out the $200,000 and you buy. Okay, so that's what you mean by equity. Okay, it's a great strategy, but you have to be careful. I'll tell you why. It's a really, really good strategy, because think about it this way, right? If you have a $500,000 property and you have a $300,000 mortgage, you have $200,000 in cash.
In equity, yeah.
Sitting in your house, earning what? 0.
Oh, that's right.
Earning nothing.
You can do anything.
What's wrong?
I'm doing it.
Yes. What's wrong? And I'm going to put one caveat: as long as you can afford it.
There you go.
The payment goes up. What's wrong with pulling out 100? Usually it's 70%, sometimes 80% loan to value. What's wrong with pulling out 100 of that 200 equity and buying another piece of real estate, or buying a stock, or buying something that you expect to go up in value. There's nothing wrong with that. So you turn that $200,000 or a portion of that $200,000 into what I call performing equity. Now, a couple of caveats. You want to make sure you can afford the increased payment, because when you take out that additional $100,000 as a second, your loan goes up, and so when your loan value goes up, your out-of-pocket cost goes up. The check you have to write every month. And especially if you buy the piece of real estate and it's not performing yet, giving you enough income, and you buy stock and you don't get enough dividends. And stocks are risky, they go up or down. So you want to be careful how you take a stable equity and buy something that's risky, right? So it is a good investment if you know what you're doing. I would encourage you to consult your real estate advisor, your CPA, or your financial advisor, and answer that and have that question answered.
Okay. Anybody? Oh, here's
now, someone said to explain the W-4 again.
Yes.
And so a W-4 is a tax form that you fill out that helps determine how much you pay in taxes. So let me explain. So let's say you don't want to pay. You don't have to pay federal state taxes as you go. Mm-hmm. You can wait, like a self-employed person who earns a 1099. They don't have any taxes deducted. They have to pay quarterly taxes, right? So you don't have to have any taxes deducted from your paycheck, but it's a very dangerous thing to do, because you're going to have to pay that money to the IRS, plus what? Interest and penalties. They don't give no interest-free loans like they give you, but like you give them. So you'd have to pay that money back. So your W-4 is the form you fill out telling your employer how much to deduct from your taxes. So if you have 2 children and a spouse who may not be working, she may be a stay-at-home mom, or a man who's a stay-at-home dad, that happens now. You usually fill out 3 dependents. Mm-hmm. And so that's how it works. So W-4. So if you fill out 3 dependents, and it just so happens every year you're getting a big tax refund, then you may want to increase that to maybe 4. But again, you have to run the calculation. You have to be very careful to make sure you don't owe money. Because if you owe money to the IRS, remember, they don't give you any interest-free loan. You got to pay a penalty on it. You got to pay a penalty on it. So you want to be very careful. You want to be very careful.
One more question in here, and we're running out of time. So I'm because they're going to shut us off in an hour. I want to get one question that was in here. Let's see. Do you have more tax advantages with a mortgage versus a home that is paid off? I know the answer to that. Let the expert do it.
Yes. The answer is yes. With a home that's paid off, so I'll give you an example. 2 examples, right? You have a home, two homes worth $500,000 each. One of them is worth $500,000. You have no mortgage on it. So all you do is you pay real estate taxes. That's right. And so let's say you pay, I don't know, $3,000 or whatever it is in taxes. 2,000. What was that? 500,000. One for $5,000 in taxes, real estate taxes. Mm-hmm. You get a tax deduction on that $5,000. That's all the tax deduction you get, assuming it's your residential real estate. But on the other $500,000 home, you have a $200,000 mortgage on it. Well, you're still paying property taxes of $5,000, right? So you get a tax deduction on that. But the $200,000 you own, you pay interest on that. And let's just call it, say you pay 5% interest on that. 4.5. Right? Right. So you're paying $10,000 in interest. And so that interest is also taxed. And so in addition to the $5,000 real estate taxes, the $10,000 interest is also tax deductible. So the answer to the question is yes. If you own a mortgage on your property, as opposed to a paid off property, you get a better tax deduction.
There you go. There you go. Now, we're going to close on this. A lot of questions, a lot of comments that I don't have an assistant, so I'm reading this as we go, but I'm also paying attention. So I'm going to miss some things. Here's the point. This man just gave you an hour of his time, free information. He didn't charge you a red cent. Instead of, okay, here's where I'm going to be me for a minute. Don't barrage me with a bunch of questions about David, okay? This man sitting right here, his name is David Adefeso, at david.adefeso on Instagram. You message him, you find his website, you find his YouTube, and you need to start following him. Because first off, the funny thing, we don't see each other as much as we typically would because we're not filming right now, whatever. But if we go film and he and I are together for 3 days, 2 of the days we talk like this. I get this information all the time. So I feel very blessed about that. If we talk about health and wealth all the time, so back and forth all day. But if you want to know, it's the guy's business. Like if you want to ask me about something, it's my business. Don't ask me about him. Go follow the dude. Go find his YouTube page and subscribe to that and get all this information. And again, if you went and sat down, and I'm going to use my son, Dave. My son just got promoted. He's a financial advisor now, and he's studying for his 66 right now. But if you sat down with my son at Fidelity for this, you would pay for a consultation. And this man and that's a 15-minute consultation. This guy gave you an hour for free. So appreciate it for what it is, a wealth of knowledge about wealth that costs you nothing but your attention. So I suggest that all of you go follow this man right now, like I do, because I pay attention. And we've got some other people who are professionals on here that wanted to join the conversation. I wasn't taking anybody else in this. This is all David right now. But if you want to message me, that's fine. I don't know that I need Dave to come back anymore, because now that you know who he is, go follow him and you can get all this information. He hasn't, but Dave, you have an open invitation here. Anytime you want.
I'd love to come back. This is fun.
Yeah. Hey, Ms. Braxton, how you doing? Thank you, bro. Thank you for your time.
Well, it's been a pleasure. Thank you very much. It's been a pleasure. I'll see you soon.
Yeah, hopefully we get back to work and we get to see each other. Thank you, man.
Absolutely. Okay, my man. See you soon.
Thank you for your time. Goodbye.
Oh, it's a pleasure.
Wow. Wow. We got about 1 minute left. Somebody in the comments, just tell me what you thought about that. I don't have enough time to go live with anybody because we're going to get shut off. And if I screw that up, then this can't be saved. So I'm going to say this. I hope you listened. I hope you took notes. I'm going to save this so that you can go back and watch it again. Tell someone else to watch it. But man, all of that information for free. And to think, I started doing this whole thing because I was pissed off about something, and it's turned into something that I could have never imagined. I feel very blessed about the amount of people that are willing to come here and share their life's work for free with the rest of us. So with that, I'm going to take off. I think I've had the most viewers ever, and that's probably because of him, not because of me, but I'll take it any way it comes. Thank you, guys. You have a good Friday, and we'll be back tomorrow. It won't be as good because I'll talk more because we have other stuff to talk about, but it'll be fun. Thank you for your time.